If you're thinking about buying a home down the road, at least 2 years or more, and especially if you're going to be moving up, or if you don't own a home at the moment and you're going to be buying your first home, then you definitely want to hear what I'm going to have to say over the next couple of minutes. This is Ben Larson with Engel Völkers, and today I'm going to talk about the impact of future prices and interest rates and how that's going to affect your buying power down the road. So first, we're going to look at home prices. So I'm going to pull up a chart here to show you. So this is a chart, projections of home price appreciation over the next year. So as you can see from most of the main economists, they are expecting appreciation over the next year. And in California, they're actually expecting it to be a little bit higher, especially Southern California. And most of them are also expecting prices to continue to appreciate into 2022. So now let's look at what rates are projected to be. So here is a chart from the Mortgage Bankers Association that's projecting what they think will happen with rates over the next few years. So you can see where we are here in 2020, and then it goes up by 2023. They're expecting it to be almost 1% higher. And one other note is that this is what they're projecting over the next few years, but a lot of economists and experts are thinking if we do get the coronavirus under control sooner, that rates will go up quicker than this. So it's something else to keep in mind. All right, so now how do both of those affect you and your buying power down the road? Well, of course they affect you. The price and rates always play into that. But how does it affect your situation? And what's, based on those projections, what are you looking at 2, 3, 5 years down the road? So let's just look at some numbers and compare now to how they're affected by if prices go up and rates go up. So we'll work with some round numbers. I'll pull up the numbers here for you. We'll get started. If you buy a home today for, say, $1 million and put down 20%, your loan amount's going to be $800,000. Let's say the rate today, like on the chart, is 3%. That makes your mortgage $3,372. Now let's say we go out 2 years from now, only 2 years. We'll just go there, not 3, 5, whatever it may be. So values go up, conservative 5% per year. So the numbers we looked at, those were national. Those they expect Southern California to be higher, but let's just say 5% a year for 2 years. That'd make the value of the home, the new value would be $1,102,500. If you put 20% down on that, your new loan amount is $882,000. So if you take this higher loan amount, plus you have rates go up, let's just say 0.5%, that would make your new mortgage $3,960, almost $600 more than what you would have today. Now let's say rates went up 1%. The new payment would be $4,210, which is almost $900 more than your payment if you bought that same home today. Okay, so now we've seen some numbers, we saw the charts, but everyone's situation is different. But in general, if you're looking at buying more than 2 years from now, I would suggest trying to push that up as soon as you can. I know it can be tight and you have to stretch. If you're in a position where you can make it work, then I would suggest doing it because you can see how much of a difference it makes going down the road. So I'm happy to have a conversation. I do it all the time. We call it a strategy session, just to see how this relates to your situation and what your options might be. So feel free to reach out anytime. Again, this is Ben Larson with Engel Völkers Realty, and my contact information will be here to follow. Thanks.